Welcome back to Alpha Market Meridian Daily Trading Hour. I'm your Eric, bringing you real-time market insight. Gold. Why? Because gold doesn't pay interest. When real yields go up, investors move their money into bonds and other interest-bearing assets, leaving gold behind. Add in a strong US dollar, another headwind for gold, since it's priced in dollars, and you've got a bearish setup. Now, let's get to the key levels you need to write down. These are non-negotiable. They'll tell you when to enter, when to exit, and when you're wrong. For resistance, the first level to watch is $4,715 to $4,740. That's a strong resistance zone. If gold rallies up there and gets rejected, that's your sell signal. Above that, there's minor resistance at $4,765. But we don't expect it to hit that today unless there's a major geopolitical shock. On the support side, we have $4,645 to $4,610. That's our strong support zone. If gold dips here and holds, that could be a short-term long opportunity. Below that, minor support at $4,580. Now, let's turn this into an actionable strategy. Our main strategy for gold today is sell on rally. Here's how it works. Wait for gold to rally to that $4,715 to $4,740 resistance zone. Look for a rejection, maybe a candlestick like a bearish engulfing or a doji. Support zone. TP3 is $4,580. If the bearish momentum continues. This way, you're not greedy. You take profits along the way, which is key in volatile markets. Now, what if gold dips first? We have an alternative setup, a short-term long. If gold hits $4,610 to $4,645 and holds, meaning it doesn't break below that support, you can enter a buy position. Stop loss here is $4,570, below the minor support. Take profit is $4,700 to $4,730, right near the resistance zone. This is a short-term trade. Don't hold it too long, because the overall bias is still bearish. Before we move to crude oil, let's recap the critical drivers for gold today. First, Fed policy. Any comments from Fed officials today could move the needle. If they hint at rate cuts, gold could rally. If they double down on high rates, gold will likely drop. Second, the US dollar. Watch the DXY index. A stronger dollar equals lower gold. A weaker dollar equals higher gold. Third, geopolitical news. Middle East tensions are always a wild card. If things escalate, gold could spike as a safe haven, so keep an eye on headlines. Now, let's shift to crude oil, WTI and Brent. Skyrocket. Then there's OPEC+. They've been cutting production to keep supply tight, which is pushing prices higher. Add in strong global demand, and you've got a bullish setup for crude. Let's start with WTI crude, since that's the most traded benchmark in the US. Key levels. Resistance first. The strong resistance zone is $95.80 to $96.50. Above that, minor resistance at $97.20. On the support side, strong support is $93 to $92.50. Minor support at $91.80. These levels are crucial. They'll guide our buy the dip strategy. Our main strategy for WTI today is buy the dip. Here's how to execute it. Wait for WTI to dip to that $93 to $92.50 support zone. If it holds, no break below $92.50, enter a buy position. Stop loss is $91.50, below the minor support. That's your safety net. If oil breaks below that, you exit to limit losses. Take profits? Again, 3 tiers. TP1 is $95.50, right near the resistance zone. TP2 is $96.50, the strong resistance. TP3 is $97.80, which 0.80, so the strategy is similar. Buy the dip at $96 to $95.50, stop loss at $94.80, take profits at $98.50, $100, and $101.50. Brent is more sensitive to global supply, so keep an eye on OPEC Plus news today. Critical drivers for crude today. First, Middle East tensions. Any news about the Strait of Hormuz or attacks on oil facilities will move prices. Second, OPEC Plus. Any hints of further cuts or production increases will change the game. Third, EIA inventory data. This is big. It's released at 10:30 a.m. Eastern Time. If inventories draw, meaning less oil in storage, that's bullish for oil. If they build, that's bearish. Make sure you're watching that report. It could trigger a big move. Now, before we wrap up the strategies, let's talk risk management. This is non-negotiable. If you skip this part, you're setting yourself up for losses. Let's go over the rules, one by one, slowly, so you can take notes. First, position sizing. Risk no more than 1 to 2% of your trading account per trade. That means if you have a $10,000 account, you can only risk $100 to $200 per trade. This way, one bad trade doesn't wipe out your account. Second, leverage. For gold, your take profit should be at least $100. This ensures that your wins are bigger than your losses, even if you have more losing trades than winning ones. Fourth, no overtrading. Stick to 1 to 2 setups per asset today. Don't jump into every small move. Wait for the high probability setups we discussed. Overtrading leads to emotional decisions, and emotional decisions lead to losses. Let's do a quick recap of today's execution plan, so you have it fresh in your mind. For gold, wait for a rally to $4,715 to $4,740 to sell, with stop loss at $4,770 and take profits at $4,650, $4,610, and $4,580. Alternatively, buy a dip to $4,610 to $4,645, stop loss at $4,570, take profit at $4,700 to $4,734 WTI crude. Buy a dip to $93 to $92.50, stop loss at $91.50. Take profits at $95.50, $96.50, and $97.80. Alternatively, buy a breakout above $96.50, confirmed close, stop loss at $95.80, take profit at $98.50 to $100.00. And remember, monitor Fed headlines, USD moves, and Middle East news all day. Markets can shift quickly, so stay alert. Don't set your trades and walk away. Check in regularly, especially around the EIA data release at 10:30 a.m. ET. That's it for today's Daily Trading Edge, your guide to trading gold and crude oil on April 29, 2026. We covered the key levels, actionable strategies, risk management rules, and the critical drivers to watch. Remember, trading is about discipline. Stick to the plan, manage your risk, and don't let emotions cloud your judgment. Trade smart, stay safe, and we'll see you next time.